let's run through just a quick brief overview of our difference between cash and accrual accounting. A lot of people find this chapter tricky, and for good reason. If you find it tricky as well, don't worry, you will get through it, you'll be fine. Cash basis accounting, this is what we use on our reg, right? On our tax purposes, and accrual based accounting, this is what we use on our GAAP, our FASB. This is what we're dealing with in this exam. Now, why do we're dealing with this? Well, sometimes you're going to have to go from cash to accrual because maybe a company did their books in cash and now they're trying to be compliant, right? So cash revenue is recorded when cash is received on a cash basis. Under accrual, you'll hear me say this a million times. Record revenue when it's earned. Revenue is recognized when it's earned, when the job is completed, when you fulfilled your end of the bargain. Under cash basis, record expenses when the cash is actually spent. And under accrual-based accounting, record expenses when they're incurred. Right? This was the one, when it makes sense, and this is the one where, when it's actually received or spent, when cash goes in or out the door. So generally speaking, when you have a journal entry that cash is involved in, this is going to affect your cash basis accounting income. Cash accounting taxed on income only when cash has been received, taxed on income even if cash has not been received. So you can see here why, especially for a small business, you probably want to use cash-based accounting, one, because it's simpler for you to do, and you're only going to get taxed on money that you've made, whereas accrual-based accounting, you could get taxed on income that you haven't even received in cash yet.